Welcome to this video about FX Volatility Explained. Very similar to what we did for stocks when we explained the volatility. We wanted to do something around FX volatility. So many of retail traders, that was probably a long time ago, when they started trading, they will be starting trading FX. Okay, so they will be starting with euro dollar, dollar yen. These days, it's probably more about cryptos or punching money into 0 day to expiry. But still, I want you to understand. So we had questions on our Discord community about, how to look at volatility. So when you are a trader, you want to know roughly two things. You want to understand by how much the assets you would like to trade has been moving in the past, and by how much it is priced by the market looking in the future. So if we look at the past, that will be obviously historical volatility. So if we look at the euro dollar here, if we look at the currency, if we take, and I wanted to do a 5 days move, so that means a move on the week. Most of the time, if you look at the euro dollar, and we're looking here since 2000, you will see that the euro dollar will be moving between -1% to 1%. So in other words, if you look at the historical move since 1980, here, this is here. If you look at the euro dollar, so I downloaded the weekly moves on the euro dollar since 1980. And as you can see, the average move, the mean move is 1.0.5%, or the median move, which is a bit lower at 0.83%. So if, as a trader, you want to believe that every single week, let's say you're not trading the swings, you're just trading, one direction, up or down, over the last 5 days. If you want to believe that you can be making on average, let's say 5, 10, 15, 20%, the only way you can make this 10%, if the mean is at 1%, is to be leveraged by 10 times. Okay? In other words, the biggest reason why brokers are telling you to be using leverage is because your underlying is not moving that much. So euro dollar, if we look since now 2021, so just after COVID, on average has been moving by 0.7% versus 0.6%. That will be the median. So let's say roughly 0.65% every single week. If you've been correct, if you do that times 52, if you take 0.6, that gives you roughly a 30% return. So anyone that is telling you, oh, I'm trading the swings on a weekly basis and I'm making, 100% plus, 200%, 500%, like most brokers have been telling you, this is because they are using leverage. But again, what you want to know is when you start your journey, when you start your trading, by how much your underlying could be moving. Taking the euro dollar, what we saw today is most of the time is going to be moving between 0.6 to 0.8% over 5 days. So we look at the past, we look at historical volatility. Now I'm interested in what is priced by the market in the future. So this is the next going forward. This is your implied volatility. So here I used I used investing.com. So I looked at the euro dollar, I looked at options, and I'm interested looking at the last. So where is the last trading? Here, this is your 1.1193. And I'm interested going forward, how to calculate the weekly implied volatility. To do that, I'm going to be using the at the money straddle. What is an at the money straddle? You'll be buying the at the money call plus the at the money put. In other words, you want to be buying the moves on the left-hand side and the moves on the right-hand side. So if we look in our example, that would be the 1192. That would be your at the money strike. What about the call? The call will be trading at 0.000336. Okay, so this is your price here. Your put will be trading at 0.03367. So this is the price that I put it. So overall, you'll be paying 0.007. I didn't put the other number. And overall, that gives you, if you are talking in FX terms, that will be giving you 70 pips, or versus the last at 119, that will give you 0.63 move. Guess what? Market is expecting going forward for the next week a 0.63%. Did you remember by how much the market has been moving in the past? So let's go back. 0.63 versus the historical move at 0.7, 0.59. So very similar. So if you look at the median, actually it's 0.59. And the average, the implied move going forward is 0.63%. So what you're going to see as well is most of the time the implied move is a bit higher than your historical move. Why? Because it's due to the Black-Scholes models, but it's due as well that when you buy a protection of a move like you do for your insurance, you know, if you do for your car, for your house, for the fire, for anything, the premium will be a bit higher than the historical move. Why? Because the insurance would like to be making a bit of money. So in other words, for the next week, you have an expected move on the euro dollar of 0.63%. And to me, again, what is very important is if I ask most retail traders when they start, 99% of them, if I say, what is the expected move on the euro dollar for the next 5 sessions, they will tell me probably 2, 3, 4, 5, 10, 15%, whatever. A stupid number, which is going to be so far away and so far above the real number. The reality is always when you trade, you should be checking your past volatility, which is realized volatility, and your future volatility, which is implied volatility. If you, for the ones that are more advanced here, this is the Black-Scholes, but we are not going to be spending too much time on it. Finally, I just want you to understand today how it works, because this is something that we talk really in depth in the 4x4 video series. I'm not bullshitting you, as you can see in the video 3, video 4. This is what we discuss with the historical returns and the implied volatility. Why? Because you always want to know. My job as a trader, portfolio manager, is to understand the odds, and to understand the odds, I want to know by how much that's been moving and by how much the market is expecting them to be moving. So if you want to know better, you have the 4x4 video series. You can subscribe. This is an online video course with 40 videos, more than 30 hours of footage, and that will give you access to 20 channels on the Discord community. So again, that was FX Volatility Explained, and as always, I hope it helps. Bye-bye.